Hello, welcome back guys. I'm taking a look at the 6-month chart here of our tool that is, and you can see that Google is actually going down a little bit. And I guess it's a little bit more obvious when you take a look at the weekly one. Like when you take a look at the weekly one, you will see that over here, that was like 3 days ago, we were sitting at 108 pretty much for Google, and right now it has been going down and it's sitting at 94, so a pretty steep decline. So in this video, we're going to be taking a little bit of a look at Google, at Alphabet, and what is going on, why is the stock dropping, and whether this is a fantastic opportunity for an investor or we should be careful. So we're going to be examining a little bit about the business itself, Google that is. And to do that, I kind of wanted to take a little bit of a look at some very interesting articles here. So for instance, what's going on with Alphabet stock. And you will see that Alphabet is finding itself accelerating the development of AI products. So what happened here? What happened is during this rise of AI pretty much, and ChatGPT, you may have been aware of it. It's an AI product that is very, very potent, and it seems to be very, very useful in potentially adding it to a search engine. And so Microsoft is potentially looking actually like it's going to be adding ChatGPT or the likes, some kind of AI technology similar to this, to their search engine product. And this is a challenge, this is a concern for Google, because obviously Google is all about advertising, and advertising comes from the fact that Google is top in terms of the search engine. And they have to keep doing that. And so when there is a challenge of that sort, it's intimidating. And this is where the stock has been going down because of this potential challenge that Google is facing right now from the likes of Microsoft, it looks like. Now, you will see here that Alphabet keeps falling on Google's embarrassing Bart AI mistake. So what happened here? 2 days ago, the stock went down quite a lot, like 5% in a day, for instance, and then like 7% in the previous day before that. And the reason for this was a mistake that Google made when they were actually presenting their new Bard AI, that is. And so as you'll see here, shares kept falling on Thursday, that is. Was yesterday, after the company's $100 billion AI mistake. So it's called a $100 billion AI mistake because it actually went down, like the market cap of the company went down about $100 billion because of that mistake. So the company went down quite a lot after the AI chatbot that they call Bard, as you'll see here, actually made a mistake. And so this kind of mistake actually did cost, and obviously investors were looking to have a very, very reliable AI presentation there, which didn't really happen. You can kind of see the fear, for instance, in this article here from Business Insider. Google has long dominated search. It's actually by far the top engine pretty much, and it's about to massively change it to meet the rising threat of ChatGPT. New AI features could intensify battles with content creators. Now remember, this is very, very important. A lot of people are using Windows, Microsoft Windows. And so Microsoft Windows tend to come with a Bing, which is Microsoft's search engine. And frankly, nobody really uses it because it doesn't make much of a sense to actually switch from Google to Bing, when Bing is actually more than likely going to be worse in terms of the kinds of results that you're going to be met with. And so people tend to continue to use Google. But Microsoft is having a little bit of a different plan of action here. They're looking to actually utilize AI to make it better, like a better experience for people to actually search content through the internet. And so when this happens, Bing may actually take the place of Google. And obviously this is a massive threat to Google, because the search engine is where most of its money is coming from. It's mostly like YouTube and Google, like the search engine, that help Google or Alphabet make its money. And so this is why they are starting to focus a lot on the rising threat of AI, and this is why they are trying to create their own version of AI, Google that is. And so this is why the stock has been going down, because there was a mistake here from Bard, Google's API. So what was this mistake exactly? Let's take a little bit of a look. So you can kind of see the mistake in this article. Google's AI chatbot Bard makes factual error in first demo, and this is something that they really should have been careful about. You will see here that they announced the AI chatbot Bart, which is basically a rival to ChatGPT. And it made a mistake in answering one of the questions. As you'll see, a GIF shared by Google shows Bart answering the question, what new discoveries from the James Webb Space Telescope can I tell my new year-old about? And Bart actually came back with 3 bullet points, and it says that one of these bullet points had the potential fact that the telescope took the very first pictures of a planet outside of our own solar system. However, a number of astronomers on Twitter pointed out that this is incorrect, and that the first image of an exoplanet was taken back in 2004. And in the news of that, investors were frowning upon these kinds of news because it's a mistake. And when this happens, it points to the fact that the AI is not that good. It's making factual mistakes, and this is exactly what you don't want to see from a rival to ChatGPT, which has been doing greatly in the past few days, or I should say weeks or months even. And so this is why the stock has been going down for a while. Now, the stock has been going down for a while, but as long-term investors, we should be taking a little bit of a deeper look at that. Like, we do know that Google is making tons of money. We have talked about it in previous videos in the past. Like, right now it's sitting at $94, and what we need to be doing as long-term investors is examining the kind of financials the company has. The most important thing to see is what kind of P ratio and price to free cash flow ratio the company has compared to the outstanding shares, of course. And the outstanding shares are going down, and they will keep going down because the company's stock price is frankly cheap right now, and Google is going to continue buying into their shares. So they will continue buying more and more shares, basically getting rid of some of the extra shares that are actually tradable right now in the market, making the current ones worth more. And so as a potential investor, this is a good sign for us, of course. It is a company that has been growing their revenue a ton, like you can kind of see it here. Their net income as well, free cash flow, everything has been going great in terms of how they have been growing. Of course, they have had some challenges, obviously. It makes a ton of sense because of COVID, because of the supply chain issues. That makes a ton of sense. But if you take a look at the financial statements, things that you can really browse at if you have access to our tool here. And remember, you can gain access by becoming a Patreon. All the links in the description box below this video if you're interested. But you will see that the company has been growing tremendously from 136 billion to 282. And I want you to stop for a while and think about it. A company was having a revenue of about 136 billion, and they took it up to 282 billion. This is very hard. It's much easier to take like $10 and make it $20, and it's less easy to make 1 million converted to 2 million. But imagine converting 136 billion to 282 billion. This means that you have to adapt to the current market and actually expand very quickly. And so in 5 years' time, the company almost doubled, pretty much, actually more than doubled their revenue here, which is insane at this kind of level. Again, we're not talking about a million here. We're talking about $136 billion. And so the company, even though it's huge, it keeps growing at an insane pace. And this is exactly what you need to be investing in. This is the great companies that we want to be having in our portfolios. And so you will see here that the net income, of course, has been pretty much following the same trend. From 30 billion to 60 billion over here is pretty much the profit that the company has been generating, which is obviously tremendous here. And the same thing applies to their balance sheet. Of course, even though the company has been buying back shares lately, you will see that the total equity has been increasing at a tremendous pace. Basically, this is a treasury. This is a treasury box. It's a company that has an insane amount of money here as their equity and pretty much their cash that they're having. And so it's basically a fantastic opportunity to invest in, as long as the stock price is cheap enough. And this is what we're examining, of course, in the videos that I'm making, and basically in the discussions that we're having here on YouTube. And you will see here again the cash flow statement, same story, from net income that is increasing to free cash flow that is increasing precipitously. Again, almost like tripling it here, which is absolutely amazing. And the only concern that I would have as a potential investor is basically, is it cheap enough to enter? Because, when something is doing great, let's say that we're having a company that is making 10 million a year, and then 20 million a year and next year, and then 30 million a year. But then they are asking us for a valuation that is like $100 billion valuation. It doesn't make sense, right? Because the company is doing great, but doesn't do great enough to actually justify the price. And so this is what our stock evaluation tool is doing here. It actually tells us the company is doing great, yeah, okay. But is it doing great enough to make sense for me to buy today? This is exactly what the company is going to be, the tool is going to be doing for us and telling us, is the company doing enough today for me to buy today based on what they are going to likely be doing in the next 5 years? So this is exactly what the tool is answering. And in order to do that, we actually project the potential revenue that the company is going to be achieving in the next 5 years. And so the company overall has been achieving a revenue growth that is about 20%. Of course, this is not going to be happening every year. And so we're going to be more conservative. We're going to go much, much more conservative. Go like 8, 10, and oops, not 20, 12, 10 is what I want you to do. 10 and 12 here. And the net income margins that the company is having is a little bit suppressed lately, and it does make sense again. But overall, they are sitting at about 22, 23, 29 over here. I'm gonna go somewhere in between 22, 24, and 26 here. And remember, this has a lot to do with software. I mean, Google is about the search engine and advertising pretty much. And the free cash flow margins, very typical, 90 to 100. So I'm going to go 90, 95 over here, and 100, and 13% is what I want to be making annually, and this is why I'm inputting it here in our tool. And if I hit calculate, the values that we're getting here, again, remember this revenue growth is super low for a company like Google. So for this one, we're sitting at 78, but for any other of these values, we're sitting at least near $100 and $121. And I myself, I actually have bought it at an even higher price. I think when I bought it, actually I think it was 118, I may be mistaken, but I bought it higher than what it is right now. And it has been going down, but the thing is, you have to be understanding what is happening with the company and what kind of company you are buying. So at the price that I bought the company, I'm still very happy for my purchase, because I think in the next 10 years or so, more than likely the stock price is going to be like 500 or something, or even more than that. Because if you go back, and again, our tool here can actually really help you with your analysis, you will see that everything for this company, with this company, is fantastic. Like the numbers, the key metrics here are insane. Everything is green, apart from the price of free cash flow, which is practically green, because this becomes green at 20 pretty much. But other metrics actually are very important as well, like the margins that the company generates. Yeah, they're down a little bit lately. It does make sense because of what has been happening with COVID and the supply chain, but this was probably more than likely going to go up. And it's a company that doesn't have any debt pretty much, and their margins are pretty great. The returns are fantastic, and has been growing at a tremendous pace. Again, remember, for such an insane, remember, we're starting at 140 billion here. That's back in 2018, and growing to almost 300 billion. This is absolutely insane. It's a company that I definitely want to have my eggs in if I am holding a basket, that is. And so this is why this is one of my holdings, and a big holding of mine, and it's going to continue being so. And right now, frankly, at this price, I'm really considering to potentially add more. The only reason why I haven't added more is because I'm already having a lot of Google in my portfolio, and I want to diversify, not actually being concentrated in a specific stock. So I want to be careful not to overdo it. But overall, at this current price, I think it's basically a steal for a company like Alphabet. But do tell me what you think about Alphabet. I'd love to hear your comments, guys. So leave a comment below. Tell me what you think about Alphabet. Is it going down more? Are you thinking of buying? What are you thinking about the company? And I hope you enjoyed this video. If you did, please also subscribe, and I'll see you in the next one. Bye bye for now.